on Australia's Business Channel. Welcome to Your Money, Your Call.
Hello, welcome to the program. I'm Brooke Corty. Whatever your wealth strategy, the last fiscal year was the worst on the Aussie share market in 26 years. We've heard a lot about it. It also meant that superannuation funds suffered their worst year since the introduction of compulsory contributions back in July 1992. So, how worried should we be? Should we be rethinking our super strategies? Is it the best or worst time to switch? If you have a question about your super, I know there's plenty of people who do. Our phone lines are open 1300 30 34 35, or if you prefer, of course, you can always email us to yourcall@skynews.com.au. Our experts tonight are Sam Henderson, Managing Director and Senior Financial Advisor at Henderson Maxwell, and Anne-Marie Essler, Technical Research at Centric Wealth. Sam and Anne-Marie, thanks very much for coming on the program.
Thank you.
Thanks, Brooke.
Obviously, a disaster year for superannuation, which is why we've started the program. People suddenly looking at their super this year and a little bit worried. Sam, you got clients coming to you and sort of tearing out their hair and not knowing what to do at the moment?
Absolutely. Yeah. I think the way we've described it in recent weeks is probably like the perfect storm. We saw a lead up to June 30 last year where we saw millions and millions, in fact billions and trillions of dollars flow into superannuation in a record year on the share market, or probably up to 5 successive record years on the share market. And then we've seen the share market drop up to 25% over the last few months. So I think there's a lot of people that are probably a little bit shell-shocked out there as far as super returns, probably a little bit shell-shocked about superannuation overall. So I suppose one of the things you're going to need to think about is to put this into perspective. Think about that the average return on the share market for the last 40, 50, 100 years has been around that 13.8 percentage range, less fees, of course. So I think it's important to keep things into perspective, not to panic too much.
Yeah, Sam, some people would be saying, well, they're going to retirement next year, the year after, so they are quite concerned. Do you have to take quite a different approach with people at the moment that are, say, retiring in the next little while and people are retiring 50 years? Well,
not really, because as Anne-Marie said, I think superannuation is a long-term investment. So whether you're 30 years old or 60 years old, you should still be really looking at 30 to 35 years as an investment time frame. So I certainly wouldn't be panicking at this point in time. I mean, by its very definition, super's a concessionally taxed savings environment designed to fund retirement. Yeah. And retirement, based on the average life expectancy these days, is up to 30, 40, even 50 years. So we generally plan for a client to invest up to age 100. And if we get fluctuations of -6 or even -15 or 20, we're not overly concerned if the overall return or average return is up around that 13.8% mark, as I said earlier.
Do you find people are coming to you wanting to switch now? I mean, say if you're retiring in a year's time, you've just lost a lot of money in the share market, people going, I want to swap into cash because I can't afford to lose any more in the next 5, 10 years? Human
nature dictates, doesn't it? So you get people panicking. So they see the market drop. I mean, the share market's down 25-odd%. So those clients that have more exposure to equities are obviously down a lot more. And particularly if you look at self-managed super funds, where predominantly 50 to 60% of the assets are held in Australian equities, you'll find that their returns are probably a lot less than -6%. So you're probably seeing -10, 15 or even 20% on those sorts of portfolios. But again, I'd draw your attention to the fact the market's averaged 13.8 over 50 or 100 years. So I don't think that's going to change.
How generally why not just put all your super in cash right now?
The problem is, Brooke, is that you will be crystallising those losses because you will be buying or you'll be selling at a time when the market is low. So people have to remember that they still have the same, generally, number of shares that they had previously, the same number of units in their managed fund, but just the price has fallen. So if they sell now, they're crystallising the losses and they won't be able to take advantage of riding, I guess, that gain when that does eventuate in the next couple of years. So in most cases, our recommendation would be to stay where they are. They might want to think about any future contributions going into defensive assets if they are really concerned about what's going to happen with the share market and even the property sector as well, Sam, over the next 6 months or 12 months. But otherwise, it's probably not a good time to start looking at other funds or switching their investment options.
Okay, so scrutinise what you've got, but don't necessarily jump to any conclusions about what to do.
The problem is that which other fund are they going to move to? Because superannuation funds are invested in the share market, and if the share market's not performing, then then you know the superannuation fund is also not going to perform. So if they're going to switch from one super fund to another super fund that's going to be still invested in Australian shares, that the outcome's still going to be the same. So